This is the Net Group Investments podcast, where we explore a variety of views and insights that investors care about. Welcome to today's podcast. I'm Demisha Greater, and joining me is Nick Andrew. Today we're diving into the concept of Advisors Alpha, the hidden value financial advisors bring to their clients beyond just picking investments. Nick, please can you just start off by explaining what Advisors Alpha means and why it's important for financial advisors and their clients?
Thanks, Tumi. Well, the concept of alpha is widely used and understood in investment management as the amount that a successful investment manager can add over and above their benchmark because of their decisions and actions. So, for example, we say a fund manager who has returned 12% per annum versus the benchmark of 10% has generated alpha of 2% per annum. Advisors alpha is a similar but less understood concept. It is the quantum of value add that the client receives because of partnering with a financial advisor and the action that the advisor recommends and implements. Importantly, it refers to the value that the financial advisors provide from advice beyond just selecting investments. It's about holistic benefits they bring, such as behavioral coaching, tax efficiency, rebalancing, cost management, and comprehensive financial planning. It's also much more difficult to measure, so often doesn't receive the attention it deserves. But just because it is difficult to measure doesn't mean it should be ignored. In fact, ignoring it undermines the probability of clients making informed decisions and the probability of them achieving their long-term goals.
Certainly true. Nick, there are some myths about the value that financial advisors can add. Can you share some common misconceptions and how advisors actually add value beyond just investment returns?
Absolutely. One common myth is that advisors are only there to give investment advice, to be able to make market forecasts, to select and switch between top-performing funds and asset classes at exactly the correct time. The evidence of this is clear. On aggregate, little or often negative value is added from this activity. In some, it is a loser's game. But that does not mean that good advisors cannot add tremendous value. On the contrary, the research shows that clients who receive good advice materially outperform non-advised clients. Just not in the way everyone thinks. The research from Vanguard, Morningstar, and others ascribes different numbers on this, but they are in the 2 to 4% per annum range. This is very, very material, but we don't hear much about it. And across the studies, the highest proportion of this alpha is consistently in the area defined as behavioral coaching. The value add comes in various forms, but can be classified in a few broad categories. First, the above-mentioned behavioral coaching, where the experienced advisor guides and nudges their client to avoid the common emotional knee-jerk mistakes we are all prone to. Second is wealth management, which includes disciplined rebalancing, which prevents unintended portfolio drift, and for those in retirement and drawing in income, an optimal withdrawal strategy. And thirdly, portfolio construction, which covers topics such as tax optimization and cost-effective implementation. These aspects often have a much more significant impact on long-term financial success than just investment returns. And they are personalized for the specific client circumstance and personality, with the objective of improving the odds of a successful outcome and, importantly, decreasing the stress for the client in achieving that outcome.
Well, Nick, you mentioned a few important factors there, and I think that knee-jerk mistake that we sometimes fall into can be very valuable when you have a financial advisor there just to help you keep a cool head and stay focused. Can you provide a practical example of a situation where a financial advisor significantly improved a client's financial outcome?
Sure, there are lots and lots of examples, but one of the most obvious, and happens a lot, and it's very material, is that many clients are either nervous of markets or just disinterested and don't get around to organizing their investments because it involves some admin and there's lots of frustrating jargon. Therefore, because of either this anxiety or apathy, they just never get started and end up with their savings in a bank account instead of a more relevant or appropriate higher risk growth asset. Over time, this delay can be devastating. The difference can be as much as 6% per annum, which over any meaningful period is the difference between retiring comfortably or not. As author Robert Allen said, how many millionaires do you know who have become wealthy by investing in savings accounts? I rest my case. Another very recent example that I'm sure many of our listeners could relate to would be the COVID experience, where markets reacted sharply and negatively. Many investors, frustrated with poor returns, looked to switch out of growth assets as they read the scary headlines and feared further corrections. Many trusted advisors were able to coach their nervous clients to stick to their plan and to stay true to their long-term investment horizon. This intervention and preventing a switch at exactly the wrong time has proved to be of huge value to the client.
Absolutely, and I'm sure the impact of that intervention wasn't something advisors and clients discussed much. Now, research from Vanguard and Morningstar highlights the importance of behavioral coaching. How do advisors help clients stay disciplined and avoid these emotional investment decisions?
Yes, as mentioned, of all the alpha we discussed, behavioral coaching is probably the most significant. But sometimes clients don't fully recognize and appreciate it. So it's vital that advisors communicate this clearly as part of their value proposition. The first step in helping clients is to have a deep understanding of their personality. Are they confident, informed, and experienced? Or perhaps they're new to investments, nervous and prone to knee-jerk reactions and comparing themselves to their neighbors. Different personality types respond better and worse to different types of communication, but the basics are the same. Make sure you communicate clearly and consistently with your clients, defining goals and timeframes, and explicitly explaining the risks. And what that really means is the potential drawdowns that will be inevitable on that journey. By managing expectations realistically at the outset and ensuring that these are understood and documented, it's much easier to refer to this strategic plan at times of negative markets and heightened emotions. During market downturns, it's very natural for clients to feel anxious and consider selling their investments. Advisors help by providing perspective, reminding clients of their long-term goals, and encouraging them to sit on their hands and stay the course. This guidance can prevent costly mistakes and improve long-term investment outcomes. But to highlight, this education and communication must be upfront and consistent. It can't be that the client hears about it at the time of the crisis.
Now, Nick, how do advisors add value through tax-efficient strategies and cost management? Is this something you can delve a little bit more into for us?
Another common value add is sensible tax planning and making sure investors benefit from the no-brainer incentives the government offer to encourage investing. These include maximizing contributions to tax-free investments and retirement funds, using the exemption available for interest income, making sure clients use their annual CGT allowance, tax loss harvesting, and tax location optimization, which simply means looking at one's overall asset allocation and positioning them in the most sensible products to optimize after-tax returns. For larger clients, this can involve efficient estate planning and tax structuring, but it's often the simple things that add the most value. Another really easy way to add value for clients is making sure they are not paying too much across the value chain, including for platforms, for product wrappers, and funds. Experienced advisors will have a good sense of each of these to ensure that value is being received. One of the ways to achieve this is to include a portion in low-cost passive investments. Each basis point saved adds up and can make a big and surprisingly significant difference when compounded over a lifetime.
Now, Nick, what aspects of the client-advisor relationship are most critical when we look at delivering advisors alpha?
To me, I think it's trust and communication that are paramount. clients need to feel confident that their advisor understands their unique needs and goals, is competent, and most importantly, has their best interests at heart. Regular, consistent, and transparent communication helps build this trust and ensures that the advisor can provide advice that truly adds value. It can also be constructive for the advisor to measure and track value add from their actions, such as tax planning, cost savings, and although more difficult to measure, behavioral coaching. Advisors should also be proactive in addressing clients' concerns and updating their financial plans as circumstances change. Some of the strongest relationships are generated over periods where the advisor has successfully coached their client through difficult market conditions and demonstrated the value of a long-term plan. Once the clients have experienced the benefits over a few of these situations, trust increases, and it is much, much easier in the future to deliver advisors alpha.
Now, looking ahead, what trends do you see in the financial advisory industry that could impact how advisors deliver value to their clients?
One significant trend that without a doubt is increasing is the use of technology, such as AI and financial planning software, which can enhance efficiency and the accuracy of advice so that the advisor can spend more time on where they really add value on the human and emotional side. Another area that technology may enable, and because it could be better at it, is personalization at scale. For example, based on a specific client's personality and activity and market conditions, it should be possible to send appropriate, timely, and relevant communication to that client in the form they prefer to ensure their actions are aligned with their best interests. This would be a huge positive, as emotional behavior around times of market stress, as we've discussed, continues to be one of the largest destroyers of wealth.
Nick, thank you so very much. Always, with your insightful answers. That was Nick Andrew. He is the executive head at Nedgroup Investments. And as you've heard, it's clear that financial advisors play a crucial role in helping clients achieve their financial goals. Thank you so much for listening. Until next time, it's goodbye from us. This podcast is for marketing information only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.